Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have with us Joshua Sherrard, who's the President and CEO of Strategic Navigators, and today we'll be talking about tax mitigation using life insurance. Joshua, welcome to the program.
Thanks, Mike. Good to be back.
Yep, it's good to talk with you. I love your approach to talking about these topics because you make everything so simple and clear. And I love how we're going to talk about tax mitigation because we can never say, we can eliminate taxes because, come on, you got to pay your taxes, but we can make them as little as possible. And you're using a really specific financial vehicle, so we're going to talk in depth about that. But give us a little bit of background on why you really focus on this, because I know that there's a lot of financial vehicles that can reduce taxes, but why life insurance?
Yeah, Mike, it boils down to something the IRS has housed in a single code section 7702, and it basically says that anything inside a life insurance is going to grow tax-free, and you have ways to access that money tax-free and, of course, leave it behind tax-free. And so if you know what you're doing, you can design an investment vehicle inside of that platform, and it can be very, very powerful. And that's really our preference. Years and years ago, I was just a traditional financial advisor, and I would sell, your run-of-the-mill traditional menu of options. And now I almost exclusively do what I call a rich man Roth, which is this insurance-based vehicle that I even call a tax shelter for your money.
And I like, I know a lot of people hear tax shelter and it's like, oh, that sounds complicated, but it's not. Using a properly put together life insurance policy, that becomes a shelter. But I also like the rich man Roth because, the reason behind that is people that don't know the intricacies of Roth, there's certain cutoffs that when you make a certain amount of money and you can only put in certain amounts into that, well, it's all fine and good, but then what? So now you got to get into, playing with the big boys. And so that's really, really neat that you kind of structure it, working with your clients that way.
Yeah, the government has given us so many different options for, dealing with your taxes. The 401k was originally designed to encourage the general population to get into the stock market. It was not even necessarily an advantage to the population, but rather just, hey, we need more people participating in the stock market, so let's tie it to their W-2, and that's how we're going to drive the money. And that whole concept of deferred taxes just doesn't appeal to me because, frankly, I think taxes are going to be higher when most of my clients are ready to retire.
Yeah. It's interesting. You say the government's given all kinds of opportunities like this, but the problem is they don't tap you on the shoulder and go, hey, I was getting ready to, submit your tax return that you filed to us. But before we do, would you like to notice all the things that you missed out on? That never happens. So you need, as the taxpayer, we need to realize what this is. And I would venture to say that some tax preparers / CPAs don't even know that these strategies exist. So when you're coming along showing clients, business owners, individuals, and tax preparers where these opportunities are, it's not a loophole. It's just something, and correct me if I'm wrong, it's not a loophole. It's just something that is there, and you can take advantage of it, but no one's going to make you.
You're 100% right, Mike. Matter of fact, I'm a tax strategist, and I work a lot on the income tax side with clients as well. But one of the things I find fascinating is you're going through IRS publications, as you're going through just the different documents, they actually have this little box that says tip, and it's got a picture of a light bulb next to it, and it outlines some things that you should do relative to that section. So in a bureaucratic world, that's their way of saying, hey, we told you. Yeah. But how many people are taking the time to read the 80,000 pages of statutes, cases, and regulations on the IRS code? So at the end of the day, you got to have advisors on your team who know what is allowed, not loopholes, but what's moral, ethical, legal that you can do to save money on your taxes.
Yeah, I think that's a big thing because I think there's so many people that are like, I want to stay as far away from the quote unquote loophole as possible, but what's allowed, what is legal, moral, ethical, that's allowed. Well, take it. If you donate to charity, you can count that in your tax, return. Well, that doesn't mean that's a loophole. It just means it's there if you want to take it. So when you're working with your clients, I really liked how you mentioned, your money within this life insurance policy can grow tax-free, but also you can leave your money behind tax-free to your heirs. And to me, that's huge, because as money is growing and then the compound interest is happening, if a lot of your money is going right out the back door through the holes in the bucket of taxes, well, then that compound interest is impeded. And then the same mindset is in place for when you do need to leave it or transfer your wealth to your heirs. If they have to pay a lot of taxes, well, that's a big, price tag to take. So when the taxes can be mitigated, reduced to as much as low as possible, but that really helps with the growth as well as the transferring.
Absolutely. And I think taxes can be the biggest enemy of our wealth if we're not careful. There's an old proverb that says, blessed is the man who leaves an inheritance to his children's children. Yeah. And most people are just hoping they can leave something to their kids. And then Uncle Sam comes along and he takes a good chunk of that. And so what I love about the insurance product is that it allows you to put money into the insurance vehicle, and there's always that death benefit component which passes along estate tax. You're mitigating that tax, what you're going to be otherwise leaving your kids with. And so that's a big deal.
Yeah. And so let's talk a little bit about that, because when someone now hears, ooh, this sounds good, money can grow tax-free and I can transfer it tax-free, that's wonderful. So I'm just going to go out and Google, set me up a life insurance policy, check. Well, let's stop, because It's a very specific and special type of life insurance.
It is. And, a lot of people, and that's why I call my version of it, if you will, a rich man Roth, because it has a lot of internal design. I like to say that we simply use the insurance vehicle as a chassis, where you're building on top of it. And part of that means that you're stripping out the things that are unnecessary. We're using a lot of complex strategies to get you some returns that are, aggressive and competitive with the market, minimizing the losses. I like to say that we get rid of taxes, we get rid of fees, because we can do that internally, and we get rid of taxes, fees, and volatility. And you can use an indexed vehicle and get all of the upside and none of the downside. And so really what we do is we build this investment vehicle, and even if we're not getting these massive returns, if you're not paying taxes and you're not having to pay fees on it and you're not losing your money along the way, you end up with a bigger balance at the end of the day.
Well, we don't need to get into specifics of all the fees and line items that can go into, like your mutual fund or these kind of accounts. But I just think of it like, when you pull up your cable bill and you look at, here's the bottom line, but you notice all these little ticky-tacky little things, and you're going, well, I guess there's nothing I can do about that. But boy, that just adds up. Well, like you just said, if you can reduce all of these fees in there and you're plugging up that hole, that keeps the ball and the needle pointed in the right direction. I think that's a big piece for people to realize.
Yeah, it is. It's I like to call it uninterrupted compounding interest, which can go a long way, and leaving that to your heirs. One of the interesting things when you talk about the end of life and leaving something to your heirs, I'm thinking about some of the older clients that I have who, maybe have to go into a retirement home or have to get that extra care from the government. What the government typically does is they come in and they sell your home, and they take half of that money, and then they basically liquidate all of your liquid assets, and they put you into these retirement homes that are charging so much money. And at the end of the day, you feel like you're not leaving anything behind to your kids. The thing about this insurance-based vehicles is that the government can't touch it. And so, they may still be able to sell your home and take half of that money and maybe liquidate your IRA or whatever it is. But this insurance, this life insurance, is not up for grabs. I think it's a significant deal for a lot of people that are considering, what does it look like for me if I need to be put into a long-term care facility or something like that?
Because isn't that, when we think of the word shelter, so that's a shelter, and I think of another word that starts with SH, shield. You're shielding it from, being exposed to certain things. So there's some benefits that way. But when you think even before you need it to pass on to heirs and legacy and things like that, what about accessing, you start, building and accumulating within this vehicle. What about accessing that money like, I kind of need it for whatever, maybe my kid or grandchild is going to college. What about being able to access it that way? Is it just sunk?
No. Matter of fact, of all the vehicles that are out there, I would argue that the life insurance vehicle is the most flexible when it comes to earning interest as well as having access. And so when you go into a life insurance product and you, again, it's got to be properly structured. I do what's called a zero net loan, which means that you can borrow money out and you pay yourself the interest internally. And basically that means that you're borrowing your own money, and that way you're not borrowing it from somebody else, and you can access it at any time. And I think that's so critical. I work with a lot of business owners. I work with a lot of wealthy entrepreneurs, and they need capital. I like to say cash is king. And so having access to that money all along the way, not just after you're 59 and a half, but all along the way, being able to access it is a big deal.
Yeah, I couldn't agree more. And I remember way back in the day, I was in the mortgage banking industry, and people would look at, paying off their home and whether that's a great decision or not. If you have a big old amount of equity in your house that you cannot access because it's paid off, and you think, oh, it's my house. Yeah, it is. But then if you need to reaccess it, you better go apply for a loan and ask permission, please, sir and ma'am at the bank, can I have my own money back that I dumped into my house? Well, freeing up and having cash and liquidity and cash flow and access to your own funds, whether it's from your home equity or from your retirement accounts through this vehicle, to me, that gives a lot of flexibility. You feel like, well, it's not locked up. It's locked in to some great, low fee or no fee and all of the growth that you're talking about. But to me, that gives me flexibility to reaccess what I'm doing it for my long-term retirement planning. I think that's such a huge thing that people need to keep in mind.
It is, and I like to say that your money needs to be able to multitask. And so inside a life insurance vehicle, you have your death benefit, which is also at play, always at play for you if it's properly structured. You've got access to your capital or to your cash value along the way. And the nice thing about that is you can borrow against that, and now you can be double dipping, if you will, where you're borrowing your money, you're out there, you're investing in something else, or you need it for something, but all the while that your money's doing a couple of other things at the same time, because you're not just all in or all out. And that's a big deal as well, because if you have a mutual fund or you have 401k or even an IRA, you're going to be in that boat where it's either all in that investment or it's all out. And that's what I like about the flexibility and the multitasking feature that comes with life insurance.
And, you were talking about, fees, and that kind of drains out of, an account. And so let's eliminate that, or, taxes, if that drains out the compound, uninterrupted compounding. So let's eliminate that. Well, here's a thought, and now this is something that it comes to my mind. Maybe it would come to someone of your clients' minds as well. You mentioned about this loan, quote unquote loan, that you can take to reaccess your money. Well, a loan means there's a payment, and if there's a payment, means there's an interest rate involved in that. Where you said that you're paying yourself back. Great. Where's the interest on that go?
Yeah, and you're paying yourself the interest. I like to say, if you're the banker, how much of interest would you like to charge yourself? Now, that's why we call it a zero net loan, because that money comes out, there is an interest paid, but it's being paid internally, and it's going right back to you. And so, again, that's got to be properly structured. If it's not properly structured, that money ends up going to the insurance company, or it ends up, just getting eaten up in the policy. So you have to have a skilled insurance agent and team making sure that they're adjusting and knowing what you're trying to accomplish. But the bottom line is you can do it where it's a zero net loan.
And I think that, to me, I thought that was the case, but I wanted to make sure that was factual. When it's properly structured, the interest goes right back into yourself because it's going back into the policy. That's huge. So I think that when people are hearing this going, wow, there's got to be some limits. I mean, can you put $10 quadrillion into this? No, there's limits. But also, aren't I correct in thinking that you can also have more than one of these policies doing all of these benefits?
You can, and I write a lot of these policies, Mike, and I can tell you that some of the things that you're looking at are your overall net worth. You're looking at health is always a factor, but when you start looking at all these different things, I like to ask the question, what's the money for? What are you trying to accomplish? So when we start understanding through getting to know our client, and we can really put a lot of it to work. I will tell you that when my clients start doing this, they get addicted and they want to do more. And there are limits on it. You can't put 100% of all your wealth into it. But at the end of the day, it works really well. I even have clients that do it and they take it out on their kids. And I mean, if they do it right, their kids' retirement's taken care of.
Yeah. Well, and kind of wrap up with this thought, because I think that some people are like, okay, wow, sounds too good to be true. So this has to be some unproven, newfangled concept. But in reality, this kind of strategy has been around for hundreds of years, and a lot of top banks put their money into these kind of vehicles. So it's a tried and true strategy, right?
It absolutely is. I like to sell and remind people that there's a lot of BOLI out there, bank-owned life insurance. There's a lot of COLI, our corporate-owned life insurance. And what we're talking about is PLI, our private life insurance. Yeah. And there's so many different names for it, and there's obviously so many different nuances. And frankly, there have been a lot of people that have treated it poorly and done bad things with it. So, like a lot of things in this world, you have to make sure that you measure it out carefully, get a team behind you that can help and do it right. But when done right, this can be, I would say, the most powerful financial tool out there to increase and grow your wealth.
And with that, I guess, it's the perfect place to stop, because, we can keep on going on, but wow, what a wonderful place to pause here and just say, if anyone's listening to this and going, Josh, help me navigate through this strategy, and perfect name for your company, Strategic Navigators, because you're not telling people what to do. You're just guiding, navigating through these questions. And when someone has questions and to see how this could benefit them, what's the best way that they can reach out and connect with you?
I always ask people to go to our website and check us out there at stratnavinc.com. They can also call the office through there. And I always love having even that complimentary conversation with someone and just say, hey, what are you looking to accomplish and how can I be of assistance to you? My whole goal is to help people move from a place of success to significance.
I love it. Well, Josh, thank you so much for coming on today. It was a real pleasure having you on the show and talking about these important topics.
Thanks, Mike.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.